Let's talk about a problem almost every investor has, but very few people actually fix it. It's taxes. Not income taxes, investment taxes. I've seen families with well-built portfolios quietly lose tens of thousands of dollars each year to avoidable taxes. And it's not because they picked up the wrong stocks or mutual funds. It's because they didn't know about tax location or they weren't using it properly. My name is Chris McClure, and for the last 30 years, I've helped clients reduce taxes on their investments and their retirement. And today I want to show you how to reduce taxes on your investment without changing your investment strategy. So let me introduce you to Paul and Renee. They're in their early 60s, they're recently retired, and they've saved about $3 million across their accounts. Roughly half is in IRAs, and the rest is in a taxable account and a trust. When we first met, they told me they were happy with their investments, they were happy with their advisor, but they felt like they were paying way too much in taxes every year. And when I looked at their portfolio, I saw why. They had their high tax investments, things like bond funds and actively managed mutual funds, in their taxable account. And they had their low tax investments like municipal bonds or index funds in their IRAs. And so from a tax perspective, they were doing the exact opposite of what they should have been doing. So here's what we changed. We didn't touch the overall strategy. We didn't change the overall allocation. Their allocation stayed the same. It was 60% stocks, 40% bonds and cash. But we moved their bonds and actively managed funds into their IRA, where the interest wouldn't be taxed every year. No tax. Then we put their index funds and their municipal bonds and their individual stocks into their taxable account. So why did we do this? We did this because those investments are more tax efficient. Municipal bonds, exchange traded funds, they generate a lot less tax. And they generate either qualified dividends, which are taxed at a lower rate, or they don't generate taxable gains at all. Just by relocating where those investments sat, we didn't change what they owned, we saved them over $28,000 per year in taxes. Now that may not seem like a lot, but over 20 years, that's more than $500,000 in after-tax savings. And here's the best part. They didn't have to change a single thing about their investments. The other nice thing is that they can use that money to help their kids and grandkids. They can use that money to help a charity, or they can use it to go on a big cruise or a big vacation every year. So this concept is called asset location, and it's one of the most powerful ways to improve after-tax returns, and it works like this. Tax inefficient investments, like REITs and bond funds and high turnover mutual funds, go in your IRAs. Tax efficient investments like index funds, municipal bonds, and stocks that you plan to hold, those go into your taxable account or your trust. It's the exact same investment strategy, but now it's built to work with the tax code, not against it. Let me give you another example. I had a client, Elena, who had a $1.5 million trust and was earning about $60,000 a year in dividends and interest. She assumed that was just part of the deal, right? She liked the investments, she liked her advisor, and she just figured that tax bill was just a cost of doing business. But about 40% of her income was coming from bond funds and actively managed international funds, both of which were generating a lot of taxable income. By restructuring the portfolio to hold those in her IRA instead of her trust account, and to change the way she invested her money in her after-tax account, we cut her investment tax bill from $18,000 a year to under $7,000 a year. So she saved over $10,000 in taxes just by doing asset location. Again, she didn't change her risk profile, she didn't change her income needs or her long-term goals. We just placed those assets better from a tax perspective. Now, here's something most people don't know. Many financial advisors, they don't actually optimize for asset location. They, of course, focus on diversification, they focus on performance, which is really important, but often they leave the tax side behind. And the difference is that after-tax returns are what you actually live on. So here's what you can do today. If you're retired or you're close to it, look at where your investments are held. If you're earning a lot of taxable income from your trust, or your brokerage account, ask yourself, could some of that be moved into a tax-deferred account? Could you shift your taxable account toward more tax-efficient funds? And you see, even small tweaks, even small changes can lead to significant savings over time. Paul and Renee are now bringing in the same income, taking the same withdrawals, and staying on track with their goals, but they're doing it with a lot less tax drag on their investments. And they're just frankly paying a lot less taxes. So if you're wondering whether this could work for you, let's talk. I help retirees and successful families reduce taxes on their investments without overhauling their strategy. So if you want to chat, just click on the link below. And if you found this helpful, please hit like, subscribe, and maybe share it with someone who you think needs to hear this. Thanks for watching. I really enjoy doing these, and I'll see you next time.